So again, we got to look at what happens when we had periodic inventory and how we calculate our sales. All we really truly care about was just recording the sales. But now that we're learning about our perpetual inventory, we know that with the word perpetual, it means that we need to update our inventory. So every purchase that we make, we have to update our inventory. And therefore, every sale that we make, we need to also calculate how much items we sell and take it out of inventory. All right, so this is the second part of chapter 7, because chapter 8 is going to be dealing on how we apply the costing methods to each and every costing inventory method there is out there. So chapter 7, just summing this part up, the bottom half is going to be dealing with sales. So of course, this is also a review. When we're looking at sales, it is the nature of the business to take our raw materials and transform them into goods and services. And with that, of course, when we're dealing with making our selling price, right, it's got to include the actual purchase price that we purchased it from, and it also going to include a partial part of what profit percentage that we want to encounter. What is our profit percentage for us selling this item? All right. And with that being said, we do need to charge sales tax. Right now it's 8.375, but that's okay. I want to keep it as simple as 8.25 for this sake of this class. Okay. It's going to be different wherever you go. All right. So let's go ahead and take a look at our very first problem here. So example here for June 1st, we bought 10 toys were sold at $9.99 each. Sales tax was $8.25 each, and the toys were originally purchased at $5.85 each. Okay, so how do we record this sale? Okay. Note that under perpetual inventory, there is an additional account that must be calculated, all right, and included when we journalize this. So what am I going to do when I record this? So let's go ahead and just focus on what the situation is.
Okay. All right. So we sold 10 toys.
Mm-hmm.
So cash or
I wasn't specific, so it could be cash or accounts receivable. Mm-hmm. $9.99, $9.99.90.
$99.90, and the sales tax of 8.25% is $8.24.
Okay.
So total purchase was $108.14.
Okay. So that's my total sales, right? Now, because I'm using perpetual inventory, there's one more factor that I need to include, and that's going to be a cost of goods sold account, all right? Now, what cost of goods sold is, again, when we utilize cost of goods sold, it's considered an expense to us, right? That's us in another sense of trying to get rid of our inventory. So with that being said, you need to include a cost of goods sold account, all right? So the first part you got correct, right? You recognize that you're going to either receive cash and you're going to receive an accounts accounts receivable, whatever form of payment you get. You're going to recognize you had sales of $99.90, and you recognize that you had your sales tax of $8.24, which gives you a total of $108.14. That's correct. Now, because we're doing perpetual inventory, we need to include the cost of goods sold account. All right? So here we're given this piece of information that we originally purchased these items for $8.85. Okay? If we sold 10 of them, how much are we going to eliminate from our inventory?
58.50.
58.50 is correct. So by adding in our expenses, right? Our expenses will always be debited unless there's a contra account, right? So in this case, we are not doing a contra account. We're actually trying to get rid of our inventory, right? But if we have a cost of goods sold and our main incentive is to update our inventory, where are we taking our inventory items out from?
Toys.
We're taking it out of our inventory, which is, again, toys. So, because you did calculate it, right? If it cost us, in order to sell one item, if it's going to cost us $5.85, I've sold 10. So, therefore, 58.50 is correct. And this is what you need to do every single time you sell an item. All right, and that's strictly for perpetual inventory. Okay, because this time we actually do care about the things that we sell, because again, we're constantly updating our inventory. So every time we make a sale, we need to minus out of our inventory items immediately. Okay, at time of sale. So that's how you complete a perpetual inventory sale. Okay? So it's the same thing as periodic, except you have one more additional step. Okay? So good. Any questions in regards to perpetual sales?
Nothing yet.
Okay.
No, I'm good so far.
All right. So, of course, you're going to have your angry customers who do not like your product, or maybe the product was broken. So, therefore, you need to be able to manage this and be able to have a returns and an allowance, okay? And same thing applies here, right? You need to make your company policy, which allows your customers to recognize that this is what's going to happen when you purchase our items, right? Again, with company policies, you want to ensure that your item is sold. So maybe limiting the number of days you have to return them, maybe make it final sale, make it so then if they try to return your items, you give them a store credit card or a store gift card. So then it doesn't make the customer not come back. They have to come back and buy something else. So there's yes, a lot of things like that. Or if you just kind of that kind of company where you don't really care about your sales, then go ahead and give them their money back guaranteed. Okay. And with that notion being said, every time you make a return, you have to return the sales tax that you charge your customers. Okay? So with that being said, let's go ahead and dive into our first perpetual sale, and then we'll dive in to see what happens when you need to make a return or an allowance. So on May 1st, you sold 50 coffee mugs for $5 each. Okay, the coffee mugs cost you $1.25 to each to buy. Okay, sales tax, of course, is 8.25%. So let's go ahead and calculate this. Customer A pays with cash for the mugs. So what are we doing now? We need to recognize what accounts.
Cash
Cash, good.
for sale, and that is that's 250 in the debit, and then we have excuse me, no, wrong.
Oops.
$270.63 is the cash total
Okay.
with the tax.
Okay.
Okay,
And then break it down.
and then
Your sales would be $250 and your tax is $20.63.
That is correct. Right? Now let's go ahead and update our inventories by creating our cost of goods sold. So if we originally purchased our items for $1.25, that's how much it's going to cost us to sell one item. We sold a total of 50 items. So what is my total cost of goods sold going to be?
$62.50.
$62.50. So 125 multiplied by that 50 items gives you $62.50. Okay, and we're directly taking it out of our original inventory, which was coffee mugs, right? We're gonna go ahead and take that away for $62.50. Right? Good. Right? Now let's go ahead and look at scenario 1. What happens if on May 10th, all right, customer A wants to return 10 coffee mugs for a full refund, right? And your company policy was a full refund within 15 days. So therefore, the coffee mugs cost you $1.25 each. So record this transaction. So they met the return policy period, right? So how are we going to record? Let's go ahead and focus on one thing first. First thing is this customer A is going to get a full refund. So how are we going to calculate this refund?
So it will be the returns and allowances.
Yes.
sales returns and allowances.
Sales, returns, and allowances. That's going to be on the debit side or the credit side?
The debit.
The debit, right? Because it's reducing sales, which was originally a credit. So yes, you're going to have a sales, returns, and allowance. What else is included?
Sales tax.
Correct.
Sales tax payable, but it's the contra account. I guess these are all contra accounts, right?
Well, sales tax payable is technically not a contra account because it's a liability. And liability,
Okay.
that one, since we've already placed it in there, you can go ahead and utilize and return that.
Okay.
So only sales are final and expenses are finals. So those ones need contra accounts.
Okay.
Okay. So we got a sales returns, we got sales tax payable, and how did customer A originally purchase this from us with?
So either cash or on account.
They did do cash, so we're gonna recognize cash. Now, how much is this $10 refund? 10 coffee mug refund. Since we originally sold it for, I think it was $5 each, correct? Yes.
So it's a total of $54.13.
Mm-hmm.
$50 being the mugs and $4.13 being the tax.
Okay, now be careful. You said mugs.
Okay.
So what was the account that you're supposed to recognize that $50 with?
Oh, cost of goods sold. Sorry.
No.
No.
Try again.
No.
We're only focusing on sales.
So it would be my cash.
Okay, your cash is the $54.
So it'd be my inventory.
No. We're not dealing with inventory. We're only dealing with the sales.
My sales tax, I'm sorry, and my returns.
Sales returns and allowances, yes. So with the sales returns and allowance, right, that's going to be for $50. Your sales tax payable is going to be the $4.13. Your cash is going to be for the $54.13. So yes, very good. Now, this customer made a return to us. So the question is, do I need to? Since they gave me back the product, what am I going to do with that product?
Gonna adjust your inventory.
And how do I adjust my inventory?
Oh, let's see here, for how much?
125 times the 10. Oops. 1250.
Okay, so 12.50. And what am I going to do when I adjust my inventory? So what am I going to do?
The account's gonna be inventory
The account is going to be inventory, right? On the debit or the credit side?
on the debit side.
On the
Yeah.
debit side. What is
Increasing it.
my equal debt? What is my equal credit account going to be?
Cost of goods sold.
Cost of goods sold.
Correct, right? We're going to, because we originally sold in the first place, right? Now that customer A is returning the product and actually physically giving it back to us. Therefore, we're going to have to put it back into inventory. Now, of course, in a realistic standpoint, you will never ever return your items back into the inventory. You're actually going to create a new account for that because, customers are not going to purchase something that someone else has already touched or previously bought, right? You're going to place it in another account for the refurbished gifts, right? Or the discounted items, right? But in this case, essentially, this is what you're doing, right? You're going to have to place it back into inventory. You're going to have to count as if it's still there. So in this case, we're going to go place it back into our inventory account, and we're going to decrease our cost of goods sold. In this case, we're allowed to because, again, there's no need to make a contra account for a cost of goods sold because essentially you're just reversing what you sold. So in this case, they allow you to do it. So yes, that's what you're going to do, and you're going to replace and put back into inventory the $12.50. Okay? Scenario 2. What if customer A wants to return 10 coffee mugs for a full refund? However, it's because they didn't like the color. All right? And you tell them that they missed the discount period, and so with lots of arguments and whatnot, you finally offer them a 15% discount, and they're willing to accept it. So how are we going to record this?
So it's still going to be, I think, the sales, returns, and allowances.
Correct.
Right?
Mm-hmm.
The amount 750.
And the amount, you said $750. What is the tax on that $750?
Oh, that's not right.
62 cents.
62 cents. And again, customer A paid us with cash. So yes, that's the first thing you gotta recognize is just the sales, right? You're just returning and making your customer happy by refunding the amount. Okay? So we already figured it out, right? It was $7.50 plus 62 cents for tax, and the total cash amount is going to be for the $8.12. So here's the question now. Did we actually refund the items?
No.
No. So is there another, do we need to adjust our inventory?
No.
No. We let them keep their items. We just gave them a discount. And we only gave them a discount on basically the selling price, not on us buying the items. Of course, this is a sale. This has nothing to do with our inventory at all. So we don't need to update our inventory. We don't need to discount our inventory because we're selling our items. We only took a discount off the original price that we sold it for. Okay? So our only main thing that we need to get away from here is that we're only dealing with sales, and that's it. Because we gave them an allowance, they didn't return the items back to us, so therefore we do not need to update inventory at all. All right? And that is it for returns and allowances. Any questions?
No.
No, I have nothing yet.
All right. Last section of the day is going to be, of course, what happens when we have our sales discounts. So again, with this, there's many reasons why a lot of stores have these sales. It's to entice our customers. You know, you might have some promotional sales, maybe like a, ad of the week. You could even have a grand opening sale, so you might have the discounted price calculated there. Store-wide sale, online deals, whatever it is, right? You can create the sales discount for any event that happens, okay? And then, of course, other discounts that can apply if you give your customers terms, right? And also, if you just go ahead, if they purchase in bulk and you want to give them a friendly discount, you may do so as well, right? So what we're going to be looking is two different options that we can be looking at. So we're going to look at the first one, which is an in-store sale. So in this case, here we go. Example for June 1st, your store is having a promotion on all items are 40% off. Okay, a customer buys a total of 10 baseball hats with cash, okay, which originally price sells for $10, okay, so that's your original selling price, okay. Sales tax is going to be 8.25%, and the hats cost you $2.50 each. Let's go ahead and record this transaction. So let's go ahead and break this down. So first things first is record the sale.
Still going to be, description will be cash,
Yes.
okay? And let's see. Hundred. Well, the total before the discount is given is $108.25. Am I,
All right. Can you take a discount off of sales tax?
no,
No.
okay, so just. Okay, so we're taking the discount off of the $100, right?
Correct.
Only, so that is going to be $40
Okay.
for the cash.
Now, if you're taking the discount off of $100, so is the
Right.
cash going to be 40?
Oops, sorry. 60, sorry.
There you go, 60.
Sorry.
No worries.
So, 60. Sales tax is going to be $4.95.
Okay, good.
Okay. All right. Now we have to the sales returns and allowances.
There is no sales returns
sorry,
going
no,
on.
that's discount.
Sales discount. Yes. Where?
Not that, yeah,
Mm-hmm.
sales discount.
Sales discount. Is it going to be on the debit side or the credit side?
Credit side.
Why credit?
Sorry about that, guys.
No worries.
Actually, no, it is on the debit because it's, I'm having trouble explaining that, but, because it is money spent, but it's discounted, so the customer doesn't pay it, but it still gets paid. Right?
Okay,
I'm saying that wrong.
I can see what you're trying to say. Yes, it goes towards what the cash, it reduces the cash, right?
Right.
Good. So therefore, you're correct there. It's a contra account, right? It's supposed to lower the sales price. Okay, so in a sense, you're kind of in the right area. I understand what you're trying to say.
Right?
So cash is going to be our first. Next is going to be our sales discount. What is going to be my credit accounts?
Sales and sales tax.
Right.
Correct. Sales and sales tax. So again, Robin, you've already figured out the calculation. So what is my total cash I'm going to be receiving?
So $64. Oops. Yeah, that's $64.95.
Correct. My sales discount's going to be?
40.
Good. My sales is going to be?
Is 100.
Correct. And then my tax is going to be?
The 495.
Yes. So that is exactly how it's supposed to be. With the cash, it's supposed to be for this $64.95 because that's how much you're receiving from the customer, right? You're only getting what is discounted, all right? You're not going to include the $40, right? You're going to charge the tax after it's been discounted, all right? So with that being said, let's go ahead and because we sold a total of 10 items, how are we going to calculate our cost of goods sold?
So it is going to be the cost of goods sold. Oops. Thanks.
$25.
It's going to be for $25. That's correct, right? $25. And we're going to take it out of our inventory items, which is right here. We know that's hats for $25. Okay. Now, what happens when we have someone who wants to buy in bulk? Okay, so this scenario here is this is also applying terms, right? Because we can also give the capability to apply terms as well to our customer. So in this case, July 1st, a customer wants to buy in bulk 100 baseball hats from your store, okay? And you offer them terms to be 5% 15 net 30, okay? So you're giving them a discount if they pay within 15 days. So with that, you're also going to charge them tax of 8.25%. And you're also going to give them an additional delivery charge because you don't have all those items readily available in your store. You want to ship them out to the customer, and they said it was fine for the $10 fee. So, how am I going to calculate this? Okay.
So it says it was purchased on an account, so it's going to be accounts receivable,
Correct.
and it's going to be for 100 items sold at $10 each
Mm-hmm.
for $1,000.
Mm-hmm.
And then my tax is gonna be times 8.25, which is 82.50.
82.50. Good.
That's my tax. And these are my items. Okay. Hang on 1 second.
No worries.
Just go. I don't care where you go. Go away. Okay. Sorry about that. And
No
then
worries.
I know I have to charge
The freight.
an
I mean,
extra
the
$10
delivery
for
charge.
delivery.
Mm-hmm.
Okay. So I'm going to start with my accounts receivable, which is going to be for all three of these, and then I'm going to break them down. Yeah.
Perfect.
So my accounts receivable will be my debit side,
Mhm.
and then the rest of them are going to come out of my credit side.
Mm-hmm.
So I have 1,000 plus 82.50 plus 10 for, okay, so it'll be $1,092.50 for my accounts receivable debit.
Good. Good.
My sales is going to be $1,000 under credit. My sales tax payable is going to be 82.50, and then my delivery charge is going to be $10 under.
Perfect. All right. Now, with that being said, because we completed our sales, now we have to update our inventory. If it cost us originally $2.50 to sell, all right, and we sold 100 items, so how much am I going to update my inventory? What's my cost of goods sold?
$250.
$250 is correct. So again, we're going to place our cost of goods sold and we're going to take it directly out of inventory for
Right.
$250. Okay. So let's go ahead and say the customer decides to pay us in full in time for our discount. So he gets to receive a 5% discount on 15 net 30. So he met the 5% discount. So how much am I going to be collecting from this customer? Assuming he paid with either cash or a check.
I thought it said it was on an account.
Mm-hmm. Yep. But he's
Oh, but
he's
they're
paying it
paying
off.
it now. Got
Yes,
it.
they're
Never
paying
mind.
off. Mm-hmm. Mm-hmm.
Okay. So we're going to assume that he paid with cash or check, and that will be our description.
Perfect. Our debit is going to be first for whatever amount that he's going to pay us for.
Right, which is going to be the $950 plus the tax of $78.38 and the $10 delivery charge gives us a grand total of $1,038.38
Okay.
for our debit.
All right.
And that'll give him his 5%. And then below that, we are going to break everything down
Okay.
on our credit side. So we're going to have our accounts payable, our sales, sales tax payable, and then our delivery charge.
What was the one before that?
Our sales tax payable,
Before that?
sales.
Not sales.
Oh, sales discount.
Sales discount. Now, can a sales discount be on the credit side?
No, it has to be on the debit side.
It has to be on the debit side. Okay. What else? Are we charging him more sales tax or are we refunding him sales tax?
We are refunding him sales tax.
So is that a debit or a credit?
A debit.
Correct. So by placing all three of those accounts on the left side, all we're remaining left is how much he's going to pay us, right?
Right.
All right. And accounts payable is not one of them because I'm not owing him money. He
We're
owes
not
me
paying,
money.
We're receiving.
Receive.
Correct.
So
Correct.
it'd be accounts receivable because we are receiving the
Correct.
funds.
Correct.
Terminology, man, it gets me every time.
So no, you did pretty
Yeah.
good. You did pretty good for guessing. But you know, there you go. Here you go. So cash is correct. We're receiving money from him. We're
So it'd be 950 for the debit for cash.
not 950. That's how much sales you are giving him, right? How much was the discount for?
5%.
5%, which is
Why didn't I write that down?
you did. I think $50. Good. $50, and how much tax was included for those $50?
The difference I want. Hold on. I gotta do the 82.50 minus the 78.38. $4.12.
$4.12. In this case, you got to round up, so $4.13, I think.
Okay.
And then, how much cash am I actually going to be receiving from this guy?
$950.
No. If he,
$1,000.
for
everything all together.
correct.
Okay, so 950.
So you did solve it earlier.
Yep, I got it. 1,038.38.
1,038.37 because
Oh,
we
you
don't.
got 37. Okay.
Yeah, because we're rounding that down. Because the tax is supposed to be $4.13, not 12 cents. So that's why you have that 1 penny up.
Okay.
Yes. So good. Now, question to you. Does this affect my inventory at all?
No.
No. That's it. The discount is applied on the sale, not the actual cost of the actual product that we bought. Okay, so it doesn't affect. So when we're dealing with perpetual inventory, it's a cross between periodic, okay? We only update our inventory when we sell our items and if they return it and to us completely for a full refund and we actually receive the items back, that's the only time we actually update our inventory. In this case, he's only making a payment on things that we've already calculated the sold for. So that is it for the chapter review. So again, this is what perpetual inventory looks like, okay? And this is what a sales look like. So we got purchases and we have sales. So to actually recognize the difference when you're dealing with both is one of them is that you're dealing with the inventory item and the inventory item alone. Everything goes into inventory, all right? So that's the difference. When it comes to sales, you need to have 2 entries in there. One to record the sale and one to actually take the cost of goods sold and update your inventory. So that's just the difference between periodic and perpetual, all right? Here we looked at the returns, right? What happens when we have a sales return. And here, this is what we're looking at when we have an in-store sale as well as looking at a personal term sale, okay? When we give our customers terms, right? And what happens when they meet them, okay? Other than that, that is it for chapter 7 completely. Yay, we've finished through everything else. Now, tomorrow, we're going to go ahead and test your knowledge on how much you retained this, okay? So, yes.
We just went through it and I struggled. I can't imagine what
I
tomorrow
know.
will be like.
All right, don't worry. You